Marc Chapman è gestore di HI Principia Fund, comparto Ucits Alternativo. Lo invito, welcome Marc, and please join me on the stage. Comparto Ucits Alternativo Long Short Equity Europa, con lui parliamo di azioni. Welcome Marc.
Thanks.
Well, first of all, just a few words on the profile of the fund and what you do.
Okay, essentially Principia is a stock picking fund, and what we do is we travel around Europe, go to conferences, do a lot of company interaction on a one-on-one basis, and through that we work out high conviction stocks across the European region of all different sizes in all different countries. So we're open-minded about what country they're listed in or what market capitalization the stock is, but essentially we focus on specific change at a company level, and that's picked up through continuous interaction with managements.
Well, based on your activity and traveling so much and meeting so many companies, what's your idea of how the current conditions of the economy and the market are impacting on the corporate health in Europe?
Okay, well essentially the macro environment in Europe is essentially not helping the European corporate environment. Growth's been subdued for the past few years, but that's nothing new. The corporate sector was basically adjusted for that now, I think. With regard to small cap companies and smaller businesses, liquidity is the main issue. There's been an injection of liquidity into the banking sector, but that's yet to funnel through into aggressive lending to smaller companies. So often smaller businesses are constrained in terms of their growth prospects by access to capital. In addition, I would say competition and competitive intensity has changed over the past 4 years. In lots of marketplaces, activity levels are reduced compared to 5 years ago, and that's meant that many companies are competing more aggressively with each other. Now, for the large corporates in Europe, it's also been a good opportunity to restructure their businesses. They've shrunk their exposure to lower growing regions and taken the opportunity to shrink their workforce where they could, introduce efficiency improvements in the form of IT and investment, and essentially improve their margins and return on capital employed through effectively deploying these measures. So the environment is no longer a shock to any of the corporate managements. They realise that Europe is stable and quite flat. The US is growing quite well. Asia looks like it's rebounding. And so they're taking advantage of the fact that there's potential change in Europe to adjust their cost bases and improve their market positions on a global scale.
So based on your meetings with your European management team, can you affirm that you feel more optimism in 2013? Where do they see opportunities for their growth and what their plans are?
Essentially, confidence has improved markedly from 2012 to 2013. And that's because Europe's reaching a level where activity is stable on a year-on-year basis. So if you take the automotive sector, in 2012, automotive production in Europe was down by 9%. So a weak year for all of the automotive manufacturers and all of the suppliers. This year, automotive production will probably only be down 3% in Europe. So still negative, but the rate of decline is much lower because activity levels in automotive, in industrials, in construction is already at base levels in Europe. So a further deterioration is unlikely. It's more likely to have stable activity in Europe and be positive elsewhere in the world. So given that backdrop, the companies are investing in their own businesses to try and take advantage of growth opportunities. For larger businesses, there's a good opportunity to expand their market share, especially when the smaller corporates are credit constrained. So depending on the type of company it is, it can either be restructuring and expanding its margins via internal restructuring efforts, or it can be more growth focused and looking at niche growth areas of the economy. For instance, technology. There's a lot of change in the technology sector, strong growth in smartphone usage, and handsets become the dominant theme in the way people interact. Lots of companies are supplying that sector and are investing to take advantage of the growth which is coming from the underlying growth from Apple and Samsung. So many European companies are well placed to benefit from some structural trends aside from what's going on in the overall economic landscape.
Well, large companies, we've seen also in Alessandro's presentation, not just in the US, but also in Europe, they are rich in cash. What are you expecting them to do with this cash? Will they invest, there will be more M&A, or they will just invest in their own balance sheet?
In terms of balance sheet usage, I think that companies are still quite conservative and they're still nervous about what happened a few years ago. That's still fresh in the memory of many company management, and so they don't want to be beholden to the financial sector. So most of the companies that we speak to are still protecting the balance sheet and either deleveraging or maintaining the cash levels they have, but are still investing in their core business through efficiency measures that they can see. So they're happy to expand from an organic perspective into either new marketplaces or new geographies where they think they can see an advantage from their position. But they're less happy about using financial leverage to expand the business. So it's more of an old style growth based on core improvements rather than financial engineering.
In this current situation, in this economic environment, it's easier for you to find long or short stories to invest in?
In general, what we look at is the absolute valuation of the company compared to a bond or compared to an alternative that an investor could hold. So we look at the risk-free rate on a bond and then add a risk premium depending on the type of equity it is. So for a more risky equity, you'd obviously require a higher return. For a more stable one, a lower one. And then we work out whether that risk premium is fair or not. At the moment, our valuation analysis would show that the risk premium in Europe is quite high compared to a bond or compared to its free cash flow prospects. So based on that, we find more long ideas at the moment than short ideas. There's lots of companies in Europe which have free cash flow yields of between 8 and 10%. In a low inflation, low growth world, that's attractive. And even in the large cap sector, you can find dividend yields of between 4 and 5%, which already exceeds the yield you'd have on a bond before the company does anything in terms of deploying capital or growing. So in general, we think equities are quite attractive from an absolute valuation perspective.
All right, let's be a little bit more specific on the long stories you're investing in. Can you give us a couple of examples of the long stocks you're picking?
Yeah, so essentially, we don't mind whether the company is a growth or value-focused business. It can be on a high or low PE rating, but it must have something interesting going on within the company. So Volkswagen is one name where we think there's interest and change within the business. Essentially, they've used the current weakness in the overall European economy to improve their market share of base-level automotives compared to the French and Italian OEMs. And they've also expanded aggressively in China and the US and have shown good organic growth there. But more interestingly, they have a platform strategy to increase the efficiency of each new model. And as new models are launched, the operating margin on each car will grow through time because they're using a modular, more simple platform, which enables massive scale benefits. So the earnings and return on capital employed outlook are very good, even if Europe is subdued. So like I said, European production will be down 3 or 4% this year. Volkswagen should slightly do better than that in terms of its market share, because although the cars are relatively expensive compared to the competition, the total cost of ownership is lower because the resale value is better, and they always make sure these dynamics are in place so that the Golf is always an attractive car.
And the second one, the second story?
The second story would be a different case. It would be Novozymes, which is listed in Denmark, and that's the world leader in enzyme production. Essentially, enzymes replace chemicals in lots of areas. So in food additives, in detergents, in bioenergy, enzymes can replace the synthetic chemicals which exist there. And so in, say, household detergents, wash and powder, at the moment enzymes represent 10% of the overall production. Chemicals represent 30%. Long term, enzymes can replace a lot of those chemicals and grow to 20%, which means the organic growth path for the company is very good in the midterm. In 2012, they had an issue because bioenergy, which is ethanol production in the US, decreased markedly because of lower exports to Brazil and because miles traveled in the US was stable year on year. They now have a new product in bioenergy which will reinvigorate the growth rate. So organic growth, which was 4% last year, is going to accelerate to 8% in 2013, then 10% after that, and then above 10% between 2015 and 2020. So this is an example of a world-leading company who has excellent technology, which is applied to various segments where the penetration path can develop through time, which means that the return on capital employed will stay at high levels and the company will be very cash generative. Now, the multiple on the stock isn't low. The PE multiple is always quite high. It's always about 20 times forward earnings, which is reasonable for the quality and growth that the company can show. So Novozymes and VW are two examples of the type of stocks we'd look at. Both have specific internal change, which is driving the growth. Both don't really rely on the European environment, and both have taken advantage of weakness elsewhere to take market share. And they're both different. VW is lowly rated on an earnings multiple basis, 7 times PE. Novozymes is on 20 times. We're comfortable with either of them if we believe in the growth path.
We've already seen Fraport, which is one of your short bet. Why is that?
Fraport essentially is the operator of Frankfurt Airport in Germany, with Lufthansa as its main customer. And essentially there's a few specific issues. One is that Lufthansa and all the airlines in Europe are behaving more rationally in terms of how they allocate their capital. So if demand declines for short-haul Europe, then they quickly reduce capacity. So rather than discounting, they actually ground planes. And that's different from the past. They're much more flexible in adjusting capacity. Now, from the airline perspective, that's good because it means that operating efficiency is held at high levels. But for the airport, it's negative because traffic growth declines. In addition to that, Lufthansa is facing increased competition in the Middle East. So competition from Dubai Airlines and the larger airports there is meaning that market share is gradually being eroded on long-haul traffic via Germany. So long-haul traffic from, say, India to China, India to the US, can just as easily be routed via the Middle East as it can via any hub in Germany. And so gradually market share is under pressure there. And then the final point about Fraport is that passenger growth and traffic drives the spend per head. And ideally, you need long-haul traffic from Asian passengers to drive a good spend per head. They stay in the airport longer, they spend more on goods and services as they're moving through. If Lufthansa loses market share in long haul, then the mix of passengers going through Frankfurt Airport is not as good as they hoped. So that means that the revenue outlook for retail spend is also subdued. So we thought expectations overall were slightly too optimistic on traffic growth and spend per head. And so we've been short of that position based on those characteristics.
That was an interesting story, but let's get back for a second to the market in general. What's your short-term view after what was the run of the major averages during the month of January?
I think short-term that the equity market is still attractive. It's attractive compared to virtually any other asset class. It's attractive on a dividend yield basis compared to bonds. So a large cap stock like to Deutsche Post in Germany, which is has a good internal story, also yields 5%. So you can get many large cap companies yielding 4 or 5%, far in excess of the bond yield. Commodities have no yield. And so even from a static perspective, equities look attractive from a yield perspective. And then based on earnings expectations, we think expectations for earnings are sufficiently low in Europe and reasonable in the rest of the world. And the forward multiple on the market, the forward PE multiple, is low compared to historical averages. Now, obviously, there's macro risk because of what's just happened, but that's well understood in the valuation. So I think compared to other asset classes, equities look relatively attractive.
All right, let's try to wrap up, your investment philosophy and what makes your strategy different from all the other European long-short equity strategies.
The fund is small, so it's very flexible. It can invest in stocks of any size, small, mid, or large, and it's highly concentrated. So we run risk at a stock level. So if we find a good idea through our contact with companies, then we can have a large position in that idea, usually for a relatively short amount of time. So it's concentrated stock picking, which drives most of the returns in the fund. Then from an overall portfolio perspective, we're quite cautious. We have a relatively lower gross and net than average. So the risk resides at the stock level, and that's what drives the overall returns of the fund. And then we try and trade around the name to take advantage of short-term volatility. So it's a combination of fundamental concentrated stock picking with short-term activity to take advantage of opportunities.
All right, we'll talk more during the panel. Thanks, Mark, for now. Thank you.
Okay, thanks.
Dalle